How the rich invest versus how the poor invest. Take two people. Same city, same age, same starting salary. 20 years later, one is a millionaire. The other is still living paycheck to paycheck. The difference is not how much they earned. It is how they invested. Today, we are going deep on the exact differences between how the rich and the poor approach investing, and it will probably challenge everything you think you know about money. Difference 1: assets versus liabilities. The poor by liabilities. The rich by assets. A liability is anything that takes money out of your pocket every month: a depreciating car, an expensive lease, the latest phone on a payment plan. An asset is anything that puts money into your pocket: stocks, rental properties, a business, index funds. Every financial decision a wealthy person makes comes back to one question: does this make me richer or poorer over time? Difference 2: stocks versus lottery tickets. When people with lower incomes want to get rich quick, they turn to lottery tickets, scratch cards, or get-rich-quick schemes. When wealthy people want to build wealth, they buy index funds, dividend stocks, and ETFs. The lottery has odds of 1 in 300 million. The S&P 500 has averaged over 10% returns annually for 100 years. The math is not close. Difference 3: long-term versus short-term thinking. The wealthy think in decades. The poor think in days. A wealthy investor does not panic when the market drops 20%. They buy more. They understand that market crashes are sales a chance to buy great assets at a discount. The average retail investor sells during crashes and buys during peaks, the exact opposite of what builds wealth. Difference 4: real estate. Wealthy people use real estate as a wealth-building tool. They buy properties that generate rental income, cash flow that exceeds the mortgage payment. This creates passive income. Less wealthy people see a house purely as a home. There's nothing wrong with owning a home, but the wealthy treat property as an investment vehicle first and a residence second. Difference 5: tax strategy. Wealthy people do not just earn more, they keep more. They use tax advantage accounts like 401k, IRA, and Roth IRA. They use legal deduction for businesses, real estate depreciation, and investment losses. The average person pays taxes on everything and invests what remains. The wealthy invest strategically so taxes take the smallest possible bite. This alone can add hundreds of thousands to lifetime wealth. Difference 6: passive income versus active income. Active income means you trade time for money. Stop working, stop earning. Passive income means your money works for you 24 hours a day. Dividends hit your account while you sleep. Rental income arrives on the first of the month, regardless of what you are doing. The goal of every wealthy person is to build enough passive income to exceed their expenses. That is called financial freedom. Difference 7: education as investment. Wealthy people spend money on learning. Books, courses, mentors, masterminds. They view this spending not as a cost, but as the highest return investment they can make. A $300 course that teaches you how to start a business or trade options could generate $30,000. That is a 10,000% return. Most people will not spend $300 on their own education, but will happily spend $300 on a weekend of entertainment. The gap between how the rich and poor invest is not about the amount, it is about the mindset, the strategy, and the patience. Start thinking like an investor today. Buy assets, not liabilities. Invest for decades, not days. Build passive income. And if this breakdown was valuable, like and subscribe to Wealth Forge new videos every week to help you build the financial future you deserve.